What is going on, investors? Hopefully you guys are doing well out there. That is right. We are back here on the channel, and it was a busy week for earnings and videos here on the investor channel. I want to thank everybody that had tuned in. We are going to do an earnings mega show today. That's where we mash up a bunch of companies that we were not able to do individual videos on, but we'll mash them up all in one video. Now, I know it looks daunting, the length of the video, but we've got timestamps. Feel free to jump around. Up above me, there's a sidebar showing you the order in which we are going to do these companies. So feel free to jump around and get to the companies you like. If we cover a company you like, please, it's absolutely free and it's super easy. Do it right now. Hit that like button on the video. It does help the channel. It does help videos like this as well. Now, I know subscribing is a secondary thing, but I'm trying to get to 100,000 subscribers. I'd really appreciate it if you like the content that we've done, and maybe this is the second or third video that you've seen of me. Please consider subscribing. I'm trying to get to 100,000 subscribers. That would be amazing. And then finally, if you want to help the channel, in the description of every video, there are referral links to Amazon, Robinhood, Coinbase, anything else that I think might be worthy to you. And before you shop or join those sites, you can hit those links, and that absolutely helps the channel out. Now, let's kick things off on the earnings mega cap show. I can't think of anything better than to start it off with McDonald's. Now, over the last year, or actually year to date, stock's up 13%. Last year, up 24%. We're paying $5.16 on a dividend on this one. That's per share per year. That's a 2% yield. I tell you what, if you're going to build a dividend portfolio, say you got your tech stocks, okay, or you got your like high growth meme stocks or whatever it is, and you want to do some dividend stuff, McDonald's really should be towards the top of the list. And when we get over the financials, I think you will absolutely see why. On today's video, we'll also look at this from a technical perspective as well. Now, earnings just happened, like all these companies that we'll be covering today. They happened last week for McDonald's. That was on July 28th, just a couple days ago. And the stock initially fell just a little bit. When they say McDonald's falls, it's like, it's usually not that much. Okay, yeah, we had this big blip back in March of last year, but pretty much the entire stock market was off at that time. But McDonald's stock did take a little bit of a hit after they were warned on supply chain issues and wage inflation. I think the latter is the most worrisome for a McDonald's shareholders, because McDonald's relies on so much labor to get their jobs done and to have the stores run. It's not like a Facebook or a Google or something like that that doesn't necessarily rely on a ton of employees. Places like McDonald's, places like Amazon need lots and lots of people labor. And if the price of that goes up, which I think a lot of people are arguing that probably will, should impact McDonald's, at least from an earnings perspective, a little bit. Now, one thing I just wanted to show you really quickly from a valuation perspective is here's price to earnings. This is from a gap basis, trailing 12 months. This is a 3-year chart. What I wanted to show you is that McDonald's just recently kind of pulled back into that mid-20s PE. Okay, we're trading right at 26. But for many years, so 3-year chart, it's comfortably traded in that PE ratio. So I think if you like McDonald's, from at least just a traditional valuation metric, it's not a bad entry point from that sense. Now, let's come over to the statement of income. That's all we're going to look at, because in my documents for McDonald's, I didn't see a cash flow. I didn't see balance sheet. I'm pretty sure we can understand that those are really pristine anyways. And for these mega shows, we'll try to condense our analysis just a little bit, since there's a ton of companies we're trying to get through. Now, here we go. Revenues. So McDonald's has the company operated restaurants. Those tend to be really, really key locations that they want to control. But then they have franchise locations, which are probably the bulk, because you see here $3.3 billion coming from franchise related restaurants. You got total revenues, combine the two sources of income, and we went from $3.7 billion. The middle column is last year. The left-hand column is this year, at least on a quarterly basis. We went from $3.7 billion up to $5.8 billion. Hello, that is 57% growth. So put that in your growth portfolio and smoke it. A company like McDonald's, which pays a 2% dividend, which has been around forever, is growing their top line by 57%. This is why on the channel, we don't cover a lot of penny stock, no penny stocks, really. We don't cover a lot of really speculative stocks. That is because you have blue chips growing 57% on the top line, and they have a 2% yield and an amazing track record. When we get over this from a technical perspective, an amazing track record of just going up. Okay. And so why would you just try to find the next hot penny stock when a company like McDonald's is basically giving everything you could possibly want out of the stock market? Now, we've got other costs here. They do not the best job of kind of laying them out here. So I'm going to here's actually total operating cost. Those went up only 14%. So your top line grew 57%. Your cost only grew 14%. Hello. So you went from 2.8 billion up to only $3.2 billion on the total operating costs and expenses. This is absolutely fantastic. Now we've got operating income. That means we went from 961 million on the operating side to $2.7 billion. So a $5.8 billion in revenue, $2.7 billion flows down to the operating side. Now you've got some interest expense over here. You've got to pay some taxes and all that, but you got net income over at McDonald's at $2.2 billion. Last year we're sitting at $483 million. This is one of the best quarters I've ever seen from McDonald's. Now, let's see if it holds true. This is the exact same data, but just on 6 months. So we get basically the full year. We're growing our total revenues by 30%. So it's a great quarter, especially probably on a comp basis. Okay. Last year, what were people doing at this time? They were staying at home. They were probably making more meals at home. A lot of people had been at home for a while, so they probably have gotten tired of maybe McDonald's takeout. I'm speaking kind of anecdotally here, but this was probably an easy comp to lap, so that's why it looks super impressive. But still, from a operating cost perspective, they only grew by 14. So even if we didn't grow these revenues nearly as fast, still would have been an amazing quarter from a net income, operating income perspective. But we see here for the 6 months growing 30%, still absolutely nothing to sneeze at. Again, a lot of people assume you pay a dividend, you're a quote unquote old man stock like McDonald's, and you're not growing. It's not a stock that you should be interested in. Take that out of your brain and throw it in the trash, because this company is still growing at 30%. The other great thing is take a look at total operating costs and expenses. Those only grew 4% from 5.8 to 6 billion. Like almost a rounding error increase. That gets us operating income growth of 87%. So that's absolutely fantastic. It went from 2.6 up to nearly $5 billion in operating income. Now we pay some interest, some other stuff. Some taxes as well. Don't let anybody tell you these corporates don't pay tax. When they do make money, they tend to do that. Net income coming in at $3.7 billion. We were at $1.6 billion in the previous period. Just absolutely pristine financials. I love McDonald's. For some reason, I don't own it. It is one, after looking at these financials, one that I'm absolutely looking to add at some point in a dividend portfolio, dividend focused type portfolio, or at least you don't necessarily have to have a whole portfolio around dividend stocks. But if you notice that your portfolio is starting to get a little out of whack, you got too much tech, you got too much oil and gas, you got too much speculative stocks. Well, one way to kind of center yourself is say, okay, my next purchase, my next $1,000, my next $5,000, whatever it is related to your portfolio, is going to be dividend stocks or something like that. Maybe you got too much dividend stocks. Maybe you need to focus more on growth. Well, I think you got it both here with McDonald's, because take a look. I'm on a monthly chart. Okay. So this is not a daily chart. This right here, I mean, this chart goes all the way back to 2008. So the last financial crisis, this one goes all the way back. This one really has been locked in an uptrend. Believe it or not, you might not believe it when I say this, but McDonald's stock has been locked in an uptrend since August of 2015. The uptrend started, it was trading sideways for like 3 years, and it is now locked in an uptrend. Did we have a blip back in March? Yes, most stocks did, but that obviously was a buying opportunity. But outside of that blip, this thing is locked in an uptrend. So any pullback to this line, and you can draw this line in a number of different ways. You could probably pull it down. You could push it up. I don't really care, but you pull back to this line and it is absolutely a buying opportunity. Okay. And so any broader market pullback, for some reason, the sector, McDonald's happens to get pullback, you start seeing wage inflation and people start really worrying about that. Tell you what, McDonald's is going to be able to solve wage inflation. Okay. They'll just go to more automation. Okay. That'll cost them a little bit more on the R&D side, a little bit more on the upfront investment side. But ironically enough, I was in a McDonald's for the first time probably in maybe a decade the other day. And there was an incredible amount of automation that I witnessed. Okay, I saw you could order yourself. There was a lot of machines, those types of things. So McDonald's is well positioned. Even if we see wage inflation, they should be well positioned to tackle that. That was McDonald's. Hang around for the next stocks coming up next. Thanks for tuning in. Next up on the list is Starbucks Corporation, ticker symbol SBUX. Over the last year, stock's been ripping. This thing's up 58%. Year to date, up 13%. We see the yield on this one. So they're paying you $1.80 per share, and they have a yield of about 1.5%. I'll talk about the importance of this and why this yield might seem lower than it actually is. Now, Starbucks is one of the stocks that I do hold. Interestingly enough, now I want to surprise people. I don't drink coffee. I don't drink at Starbucks. I haven't bought something from Starbucks in a very long time. But what I recognize about Starbucks is that they can put coffee, which costs maybe 10 cents in a cup, and charge more than its competitors. I love brands like that. So I look at Starbucks not really as a coffee company, but really its own brand. And I look at it in the same way I do Nike. Nike can take a pair of shoes, put a swoosh on it, put a Jordan logo on it, and all of a sudden charge way more than its competitors. And I love companies like that. The other thing that I love about Starbucks and Nike, believe it or not, is dividend growth, which we'll talk about here in a second. Now, Starbucks did report their earnings last week on July 27th. They did raise their guidance, but really just on the low end. So they were at, for the full year guidance, they were at 29.1 to 29.3 billion. They're still at that 29.3 billion on the top end, but it looks like they boosted up the low end of the guidance by about $600 million. They were at 28.5. Now they're at the 29.1 that I talked about. Now, the other thing that came through this week is coffee futures sync in their biggest move down. So the price of coffee, at least on a futures contract basis, moved down its lowest price in like a decade. So you got to think that's got to be good for Dunkin' brands, obviously Starbucks, McDonald's, those type of things. But one thing that I want you to keep in mind, just like jet fuel, just like a lot of cost out there, big gigantic corporations like Starbucks and others actually hedge their cost. So they're locked into their coffee cost already. Okay. I don't know the finer details of it. I don't know if they're locked in for 6 months, a year, 2 years, whatever it is. But when you see a decline in price on coffee beans, it doesn't necessarily mean that that will flow directly to Starbucks's bottom line over the next 2 quarters. Now, if they stay this low and Starbucks can do some creative hedging, well, maybe they can lock in even lower cost in the upcoming quarters, and that certainly will be beneficial from a financial perspective. Now, a couple things on the Starbucks release. One thing that we want to talk about is this was like the easiest quarter ever to comp against for Starbucks, because think about back in June of last year, so really those 3 months, like March, April, May, June, or April, May, June, people were not working. People were staying at home. People were not getting their morning coffee. They weren't having their morning commute. They weren't showing up. When I used to show up at an office, people would show up at the office and then immediately go get their coffee, okay? Almost like to take an extended break from actually having to start work. And so we see the change in comparable store sales. We were at negative 41%. So it just showed you how big the shutdowns really impacted Starbucks. Well, we snapped back in a big way, like a boomerang in Australia. That thing came back 84% comp growth over the last year, and we're really seeing across the board strong growth. So what does this show you? You might wonder, look, it was an easy comp. What does this show you? What it shows me is the power of the Starbucks brand. The power of the Starbucks brand is there, and people were making coffee at home. They potentially could switch brands. They could change their habits of drinking coffee. Well, they came back, and they came back in a big way, and that is great if you are a Starbucks shareholder like myself. Now, let's come to the statement of earnings. We're going to look at revenue, profit, and then we'll look at this from a technical perspective as well. So let's take a look. Obviously, going to be a fantastic quarter. You've got your net revenues here. So we've got our total revenue after we count licensed stores and company operated stores. Again, the bulk of what Starbucks does is company owned. We've got total net revenues coming at, just up 77% from 4.2 billion up to $7.5 billion. Now we've got distribution costs, operating costs, we've got general administrative costs, some other costs here. That gets us down to total operating expenses here Look, we went from 5 billion up to 6.1 billion. That's only 22% growth. So yeah, you guessed it. When you grow your top line 77%, you grow your bottom line, or really not your bottom line, your expenses 22%. Yeah, your operating income is going to be absolutely fantastic. In fact, last year we lost $703 million. So when this company's sales fell off a cliff, so did operating profit. We lost $703 million, but guess what? That bounced back in a big way to $1.5 billion. So off $7.5 billion worth of revenue, 1.5 of it flows down to the operating side. You got to love that, because think about it. First of all, coffee is commodity business, but also Starbucks operates, they have to pay leases on a lot of the stores that they own. They have to pay their employees, training, distribution costs. We see all the costs right here. Look, distributing the coffee and the actual cost of operating the stores are massive, massive costs. They still flowed $1.5 billion down to that bottom line. Now, we've got some interest expense that they've got to pay. We do pay income taxes. I tell this to your local congressman or woman out there is, look, when we lost money at Starbucks, we had an income tax benefit. Probably makes sense, right? From a business perspective. When we made a bunch of money, we had to pay a bunch of income taxes. So these corporates do pay income taxes, believe it or not. Net earnings attributable to Starbucks, $1.1 billion. So off this 7.5 in revenue, 1.5 flows to the operating side after we pay taxes and interest. We netted out $1.1 billion. That is good for 97 cents per share. You see in the last period, we actually lost 58 cents. Now, here's what I was talking about from a dividend perspective in the previous year. So here's cash dividends declared per share. Last year, we were at 41 cents. Now we're at 45 cents. You might say, well, that's only 4 cents. No, that's 10%. This is a little less than 10%, but that's 10%, okay? Imagine if Starbucks grows their dividend again another 10% this year. That would put them very close to 50 cents. Then they'll raise it again the following year. Let's say they do it another 10%. Then they're at 55 cents. Then they're at 60 cents. So you can see in 2 or 3 years' time, you go from earning 45, you go from 41 cents up to 45 to 50 to 55 to 60 to 65, that type of growth. So here's what I want you to think about. If you're just new to dividend investing, or you're overweight tech stocks or overweight stocks that don't pay a dividend, you want to start centering your portfolio a little bit. And I think it's actually a good idea. What I want you to do is not just focus on this yield, this 1.5%. Amateur investors, newer investors, go hunt for the highest yield, and they go hunt for the stocks that pay the most, not realizing that maybe that dividend rate is not going to increase. Maybe it actually will go down. Whereas in Starbucks' case, it's actually the opposite. So yes, at today's price, at $121 per share, you're only getting 1.48% on a dividend yield, because you're only earning $1.80 per share on the stock in terms of dividend. But next year, maybe they pay $2. Then the next year it's $2.10. Then the next year it's $2.25. Then the next year it's $2.50. Then it gets close to $3. We'll start calculating your yield then. Imagine if you hold Starbucks long enough to where you're getting $3, $4, $5 per share on a dividend rate 6, 7, 8, 9 years down the road. Well, all of a sudden, this dividend yield looks way higher than what you initially got, right? And so that is the power of companies like Starbucks. The two reasons why Starbucks is in my portfolio. Number one, I love the brand. I love companies that can take a commoditized product like some liquid in a cup, put a green straw in and some lady on a logo, and all of a sudden it's $5, $9, $10 more than any other competitor. I love that. The other thing that I love is dividend growth, and you're getting both of those things at Starbucks. It makes it a winning investment in my perspective. Now, this stock from a technical perspective, it's run hard. It's been locked in uptrend since June of last year, and it's just been running. Okay, so two questions you might have. Should I just buy in right now and just buy it? Well, yeah, if you did that, I wouldn't necessarily be super aggressive. Okay, say you wanted 10 shares of Starbucks, which would be, I guess, $1,200 or so. I'd start with a couple shares, see if you can get a pullback. What would be a pullback? If this uptrend is intact, you're pulling back to somewhere on this line. Okay, you could draw this line lower, you could draw it higher, but a pull back to that. Look, it looks like we've kind of reversed up here. Okay, the stock hit all-time highs at 126 and has reversed trend a little bit. Can we come back here and retest this level? I think absolutely. We retest this high right here at 118, 119. Sure, that's a buying opportunity, right? That's only a couple dollars less than where we're at now. If you want to know if the trend has been completely broken, you're looking, okay, so you have low here, higher low, higher low, higher low, higher low, all the way up. We've been making higher lows now with some exceptions, okay? And so on those exceptions, we could come down between, I have it marked out here, between 109 and 114 or so on the stock. Again, that would break these lows, or at least meet them. That would be a serious dip on Starbucks, and you would be at risk of breaking this uptrend, okay? And so you could step in here. This is where I'd monitor it very closely, okay? Because you pull back to these ranges, it would be a bounce opportunity for Starbucks. I could see the stock bouncing at these levels. The other thing that could happen is we break these levels, the uptrend is broken, and we pull back, and this ends up being kind of a shorter term top on the stock that we'll have to retest at another time. So that's what I'm seeing from a technical perspective from Starbucks. It's not a run out and go buy this stock, but it is a stock you want to monitor. It is a stock where the 1.5% yield on it is sneaky low because, like I said, this company is likely to grow this dividend by 8 to 9 to 10%, maybe even more in really good times. And that will increase your yield over time. And that's what I've been doing with Starbucks. I think I got into this one for like maybe $80, $90 per share. So you can imagine at $80 or $90 per share, I'm getting $1.80 and probably next year close to $2. My yield is much, much higher than what's quoted on financial screens. So that is something that you want to keep in mind when you're going out there hunting for dividend stocks. That was Starbucks. Next company is coming up right now. Next company that we're going to cover is 3M company, ticker symbol Triple M. This company does pay about a 3% yield. That is $5.92 per share. Now, over the last year, this stock is actually up 30%. Hello. Over year to date, it's up 13%. It just reported their Q2 earnings back on July 27th, and they were strong earnings. We'll take a look at them, and then we'll obviously take a look from a technical perspective as well, which I think is interesting. I think you're going to want to hang around for the technical part of 3M. Now, what's interesting is with 3M, look, maybe you invest in 3M, maybe you don't, but one thing that you can take away, this is why I like looking at a broad range of companies, even if I'm not invested in them, or maybe not even interested in invested in them, is you get an idea on kind of macro environment. So one thing that we're seeing out of 3M is there's all this talk in the stock market. Is inflation temporary or transitory, as the Federal Reserve wants you to believe, or is it here to stay? Are we going to see year after year growth of inflation? Well, at the current time, right now, 3M is absolutely seeing higher costs. They projected that raw material costs would impact earnings per share for the full year between 30 cents and 50 cents per share. That means because of the higher cost, their earnings per share was going to be 30 to 50 cents lower for the full year. Now they're projecting 65%, which is more than double the low end, and up to 80 cents on the high end. This is what you're going to have to subtract from their full year earnings because raw material costs are going up. Now, the other thing that we saw, at least in the trend over the last couple months in this quarter, is that mask mandates and those type of things started to go away in different states. In fact, even out here in California, believe it or not, the mask mandates went away for the most part. Now, since 3M is a big maker of masks, that they saw their sales fall by 11%. So here's the deal. Some of you watching might not like the mask. Look, I'm not here to tell you one way or another on these things, okay? I'm not a scientist. I'm not a doctor. I'm an investor. And here's what I would tell you. If you don't like mask, or if you like mask, whether you like mask or you don't like mask, 3M could be the company for you, because here's the deal. If you're forced or quote unquote mandated to wear a mask, well, I would maybe go out and buy some shares of 3M, and then you won't mind it, because then the sales are going to start going back up at the stock you just bought. And if you don't like mask, well, look, you're just going to have to deal with mask sales falling off a little bit at 3M. Let's jump over to the statement of income here. We've got net sales here on the top line. We've got the 3 months ended and a 6-month view. All things being considered, just super steady, right? We grew about $1.8 billion here. Over here, we grew by a little more than $2 billion and some change. All things being considered, we're seeing just steady growth from 7.1 to very close to $9 billion on those net sales side. Now they have other operating sales, right? Cost of sales. This is where you're going to see the quote unquote inflation kind of tick in. This number is obviously going to be higher because you rose your sales, but it's also higher because they're having to pay higher material costs. It went from 3.8 billion up to 4.7. We're seeing similar increases over here as well. General administrative, relatively flat. Research and development, relatively flat. All things being considered, our total operating expenses went from 5.5 billion up to very close to $7 billion. So off this $8.9 billion in sales, we subtract this 6.97, that gives us operating income right here of 1.97 billion, or nearly $2 billion. Okay, that's really up nicely over the previous period. So you're seeing that you grew your top line. This is what I like to see in these really mature businesses. Okay, we grew top line by, we'll call that 1.8 billion, and we grew our operating income by about 200 million. So a fair amount of it flowed down. Okay, this is not necessarily a high margin stock, but it is very, very nice in that perspective. Now we've got our income before taxes. We got to pay some taxes, believe it or not. And we've got some other expenses here. That gets us down to net income right here at $1.524 billion. Again, we bolted on about 200 million up here. We bolted on about $200 million down here to the net income side. Earnings per share come in at $2.62%. On a diluted basis, you're looking at $2.59. Again, you're getting about $5.92. So they're paying out huge over here. Okay. So this is for 1 quarter, essentially. Here's for 6 months. They're paying you $5.36, or excuse me, that's what the company earns. So they're paying you out almost like a half a year of earnings over at 3M. You gotta love that, okay? And then also think about, you do have some dividend growth as well here at 3M. They're constantly growing their dividend. So yes, you're buying in today at this 3% yield, but over time, especially if you hold this thing 5, 6, 7, 10 years or more, and they continue to grow this dividend, well, your yield will just magically keep going up year after year, especially if you don't add to your share. So that is a very, very important thing to imagine. Now, as you'd imagine, 3M, very, very, I wouldn't say crystal clean balance sheet, but very consistent. Look, total assets just ticked up marginally since the beginning of the year. We do have some long-term debt, but it's basically flat. Everything basically flat from that perspective. And I won't waste your time with cash flows. Not a lot to see here as well. If there was something there, I would show it to you. Now, from a technical perspective, I am seeing that we've pulled back to our trend line. Look, you could draw this trend line in a number of different ways. You could drop it lower, you could start it over here, you could start it higher. I don't know. I don't really care. I've put it in here. I think most technical analysis guys will do that as well. And we're hugging this line. Take a look. We're sitting here right at 197, okay? All along the way, not all along the way, but for the most part, we've been creating higher lows with some deviation. And I think right now we're experiencing a little bit of deviation. Wouldn't really be concerned about this one really totally breaking trend unless we got a below, we'll call it about 190, 191 on this one. You get below that, and it looks like maybe we've rolled over, okay? One thing that might happen with 3M is that we just flatten out here, okay? We've been on a monster run up here. I could see us flattening out to a certain degree, and that could be an area where you accumulate shares of 3M. Now, if this trend breaks, there are some areas lower here that I absolutely would like on this, but we'll wait and see. I think you want to monitor 3M over the coming days. I think this inflation stuff is probably going to impact this stock a little bit, and the more talk that inflation, maybe it's temporary, but maybe it lasts like a year, maybe it lasts 2 years, 18 months, whatever it is. Well, I think investors will take that out a little bit on 3M. But think about this. 3M's competitors are going to be dealing with the same thing. And are they as financially healthy as 3M? Are they as diversified as 3M? I know we only talked about mass. Look, this company has like a ton of product. I mean, just an insane number of products that they produce. So one goes down, one goes up, mass go down, other things go up, those types of things. And so I think 3M will be incredibly well insulated, not to the pressures of inflation, but their competitors will be the one that probably feel it the worst, and 3M will be there to gobble up market share, in my opinion. Now, from a traditional valuation perspective, when I see a stock looks like this thing wants to roll over, right? Because we have a high here, lower high, little bit lower high, right? It looks like what we're starting to develop, and I'm not saying this is what's going to happen, but this looks like to me, this is what we're developing. Little bit of a rollover with 3M. And so I think you're going to be able to buy the dip on this one. From a valuation perspective, right now we're sitting at 20, and I've got a 3-year chart. We could even jump this back to 5 years. This stock has traded higher than 20, but that's where it comfortably is. So if you can get this under 20, this is PE, price to earnings trailing 12 months. We're sitting right around 20 on that. If you can get it anywhere south of that, you're actually, I think, getting this historically pretty good value, okay? It's occasionally been as low as 15 on this one. You get it down at 15, I think you should jump for joy. That'd be a spot where I'd absolutely at. But I'm seeing from a technical perspective, maybe starting to top out here, maybe starting to roll over. Now, it could reverse, okay? This thing could reverse and let me clean this up a little bit, and I'll show you just kind of some of you guys are probably watching this from the bullish perspective. You bounce here. This is a very logical spot for 3M to bounce. You're looking for a bounce above 206 on this one. Bounces above 206, forget everything I said about a topping pattern. This uptrend is still intact and it is still going. That's why I said at the current price, not necessarily the worst spot. I wouldn't necessarily go all in. If you're trying to get 10 shares of 3M, 1-2 shares here, hoping that this is the area that it bounces and that you're able to capture some of this upside would be a spot. But if this uptrend is broken technically, we are coming lower, and I think there's some buying opportunities down there for 3M. So hopefully you guys enjoyed that one. Be back again with the next video right after this. Next stock that we are going to talk about on today's show is the Ford Motor Company, ticker symbol F. Year to date, this thing's up 58%. Over the last year, up 107%. 107%. Ford Motor Company, they just reported their earnings on July 28th, and the stock got a little bit of a bump from that. Okay, they boosted their full year outlook. They talked about chip demand. Obviously, if you're a fan of this show or you're a fan of the stock market, you realize there is a semiconductor, especially an auto semiconductor chip shortage. Ford and others, even Tesla and a lot of car makers have had to slow production, or in some cases even shut down production because those chips are not available. They talked about the back half of the year being a little bit better from that perspective. Then we'll go into the numbers with Ford, and then from a technical perspective, ooh, this one's setting up real nice. So yeah, we're up 100%, but this one is setting up in a formation that likes to go, you guessed it, even higher. So we'll see what happens with Ford when we get over from a technical perspective. Now, from an earnings perspective, we've got our statement of income. We got our revenue. Doesn't look great because take a look. Actually, it does look great. Excuse me. From the left-hand column, I got my columns mixed up. Left-hand column is last year. And you can imagine last year was a little bit different. People weren't commuting as much. People weren't driving as much. I looked at the miles. I have to track my miles for my taxes and things like that for my car, being self-employed. And I looked at my miles and I'm way under my lease mileage on my car. And so people just weren't driving. They weren't updating their cars. And now we're seeing the reverse of that. Okay. Used car prices are through the roof because everybody, I guess, wants a new car, or at least a newer car, newer used car. And we're seeing over at Ford, we went from $16.6 billion on the automotive side up to, you guessed it, $24 billion. That's our total revenues going from $19 billion up to $26 billion. Even on the 6 months, we're really seeing just a strong year here. Okay, we went from $54 billion up to $63 billion. Now, unfortunately for Ford, it gets a little ugly after that, okay? Take a look. We spent $22.9 billion just on cost and sales, and we've got selling, general, administrative as well. We've got Ford credit, interest, and other stuff there. That gives us total cost of $26.7 billion. So off $26.752 billion worth of revenue, we had $26.774 billion worth of cost. That is essentially break even, or in this case, a $22 million loss. Look, it's not as bad as last year where we lost $2.7 billion. Ford is turning things around. Think of it as like a 3-point turn, right? In your Ford pickup that doesn't have great turning radius, okay? You got to turn, you got to hit it in reverse, turn, back, go forward, okay? Ford's probably in the putting in reverse stage, okay? They're still not going forward in terms of positive earnings. Now, we see here for the first half, they did turn it around, okay? $2.4 billion worth of positive revenue, but we're still dealing with chip shortage, still dealing with a little bit of a parts inflation and those types of things. So I still think Ford's going to be a little bit stuck in neutral in terms of an earnings perspective, but it is showing you they have turned the corner, okay? And they have turned the corner in a major way. And if we can get chips back in place, we can get more, the economy back in place where people just aren't temporarily buying new cars. Next year and the year after, they're constantly buying new cars. And on top of that, you've got the tailwind that EVs will provide. The Ford F-150 electric car looks fantastic. If I was in the market for an electric pickup, that would be high on my list. They have other models that they're going to release as well. All things being considered, things over at Ford looking way better than they were a year ago from a earnings perspective. From a balance sheet perspective, they can survive things for a pretty long period of time. They got $22.9 billion just in cash. They've got another 18 in receivables. That's $40 billion there. They've got receivables on the Ford credit side of excess of $34 billion. They've got inventory sitting at $13.5 billion. So you actually like to see that their inventory has ticked up. You don't always like to see this with companies with inventory. I like it here because it means that maybe they can't finish the goods, right? They don't have the chips to finish the truck. But once those chips come in, they're going to be able to slap those into the cars and get those out on the lot and start selling those. So I like that from that perspective. All things being considered from a liability side, look, they have some long-term debt, okay? They have some other debt on the balance sheet, but they have a lot of cash here, actually. And from a cash flow perspective, that's actually what Ford leads off with. From a cash flow perspective, we pull down this $3.8 billion of positive net income. That's on the top line of this cash. Now, what they also do is they have a lot of depreciation and tooling, okay? You come out with a new car, you come out with a new method to make the car, new methods to make the different parts or put them together, or robots and those types of things. Well, you depreciate that over time, but that's not that's a non-cash charge. So I can understand that charge with Ford. You got some other costs as well. All things being considered, decent story from the cash flow perspective during the first half of the year. $5.2 billion worth of positive cash flow. They did some capital spending, but it's in line with where they've been at before. They've done some principal payments of long-term debt. You see sitting at $26 billion. And they did issue some new debt, but it's less than what they actually paid off. So they are doing a nice job over at Ford. I think from a cash flow perspective, balance sheet perspective, earnings perspective, everything is looking pretty good over at Ford. So you can imagine that is why this stock has been rallying. Look, it's not all based on headlines of a electric Ford F-150 or that type of thing. It is based on these numbers, and that's why we cover these numbers so much. Now, this thing has been locked in an uptrend. You could try to draw a trend line in here, but boy, it has just really exceeded those expectations everywhere across the path here. Now, what I want to show you is we've made technically what I believe is referred to as kind of a pennant formation here, and it's very classic, and we broke out above it only to come back a little bit. Okay, see these two red candles? I'll zoom in a little bit more so those of you that are on a phone can see this even better. Okay, we've got these two red candles. So we were in this pennant formation. It broke, but it looked like it was kind of a fake out, but it's still not broken yet. Typically on these pennant formations, you take this bar and you put it right here. And this is what from look, I'm not saying this is what's going to happen or what I think can happen. I'm just telling you from a technical perspective, this is what the chart guys look at. Look, I have comments on my show like, oh, the technical stuff is a bunch of BS. Whether it is or not, I don't really care as an investor. I just know there are people out there in the market that really closely pay attention to this stuff. So as an investor, I think I should probably closely pay attention to it as well. And so here's your flagpole. Here's your flag. And what often happens, or at least from a technical perspective, this is what we are expecting. We're expecting a move from 13 up to 19 on this one. And it would make sense a little bit. Okay, you're really looking for a break above the all-time, or not the all-time highs, but the current highs, or at least maybe a 52-week period high of about $16 on this one. You break above $16 on this one, and you've got higher momentum. And yes, I could see you carrying into the $18, $19 per share range. So what I would look for with Ford over the next day, really, this is like next week, Monday, Tuesday. Some of you guys are going to be watching this video Monday or Tuesday. I'm looking for this to either hold or break down. Okay, we break below here, it might just delay the pennant. Maybe we have to drop it like this or something like this. But if we start upward momentum on this one, we start Monday, Tuesday with green candles, we can get above 1481 on this one. This is a swing trade idea. This is a buy the dip opportunity. This is an opportunity, options play if you want to do that. Options got to be pretty cheap with a $14 stock, right? Okay, $14 to $16, very much in play. Look, on a per share basis, that's about $2 per share. On an options contract, boy, oh boy, you could probably make a fortune if this thing moves $2 per share. Okay, so that's what I see from a technical perspective. Very bullish. From a financial perspective, looking pretty good. If we can get the story on inflation to kind of flatten out and chips coming back and getting back in these cars, and these car companies can get all their production lines firing on all cylinders, look, this company's well positioned for the upcoming year. That was Ford Motor Company. Hopefully you guys enjoyed this one. Next company on the list is Spotify, ticker symbol SPOT. This company has a $43 billion market cap on this one. It's one that is recommended that I cover here on the channel. I think this is the first time I've gotten to it, so sorry about the delay on that one. Now, look, when we get over to the stock chart with Spotify, holy crap, we are at a very critical level, so we'll talk about that from a technical perspective. Now, from a fundamental perspective, Spotify just reported their earnings on July 28th, so just a couple days ago. Now, I want you to forgive me a little bit. All these figures are in euros, okay? So I just want you to keep that in mind when we go through these figures. Obviously, the euro is different from the dollars. If I happen to say dollars, it's obviously out of habit of doing hundreds of these in United States dollars, and I also want you to keep in mind when we factor in something like valuation, where you're looking at revenue in euros versus valuation in billions of dollars, those are some things that you just want to think about. I'll try to walk you through those as well here on the channel. Now, in terms of guidance, okay, I think that's the most important thing with a company like Spotify. They're looking at monthly active users at between 377 and 382 million, okay? The consensus was at 367, so they're doing a nice job there. Premium subscribers, these are the people that are paying, I think, to listen to the music. They also have like an ad-supported one as well. I like that model, okay? I like Netflix, but I don't like that they have only a one-way business model, okay? It seems to work for them, right? But I like that Spotify offers that option, okay? They've got between 170 and 174 million paying subscribers. The consensus was almost in the middle there, about 171, 172. Their gross margins coming between 24 and 26%. Consensus was at 25. Now, they're already guiding for Q4. They're giving you really nice visibility into this company. They're looking at total monthly active users over that 400 million mark. Okay, so Q3, they're going to be at 377 to 382. They're going to grow to this 400 to 407 million mark. On the premium subscriber side, they're going to grow in Q3 from 170 to 174 to 177 to 181. So solid growth over at Spotify. Let's see how it translates from a financial perspective. We've got our 3 months ended here. The left-hand column is the most recent quarter. The middle column is last quarter. So you get a quarter over quarter view. And then the right-hand column, or the third column from the left, is actually last year. So you get a year over year view. And they're also giving you a 6-month over 6-month view as well. As you can imagine, since they're guiding to stronger premium user growth, even free user growth, we are seeing growth quarter over quarter, year over year. We went from 2.15 billion last quarter, and this is in euros, up to 2.3 billion. Last year, we were sitting at right at 1.9. Okay, really solid. Okay, now this is not a high margin business. So those of you that follow the channel know I like to check some box when I buy companies, okay? And they don't all have to check this box. When you're looking for dividend stocks, they might not be able to check this box. When you're looking for different types of stocks, maybe just ones that are super steady, somewhat safe, okay? They don't have to check all these boxes. But a high-flying stock like Spotify, which you're paying a $43 billion valuation, that's in dollars, and in a quarter, you got 2.3 billion. In 6 months, you got 4.5. We'll give them credit for close to 10 billion euro worth of revenue. That's a pretty hefty price to pay, in my opinion, for that valuation. So they better be growing quickly because the gross margins aren't that great. Okay, so cost of revenue off 2.3 billion euro worth of revenue. Our costs were 1.7. That gives us gross profit, and I don't want to say only, but it's pretty much only $663 million. So off 2.3 billion euros worth of revenue, 663 million of it flows down to the gross profit. That's teensy weensy margins, especially when a lot of people probably think of this as like a tech play. We got for the 6 months, same thing holds true. Off 4.5 billion euros worth of revenue, 3.3 was in cost of revenue. That leaves us with only 1.2 billion in terms of gross profit. Look, we've got other costs here: research and development, sales and marketing. You think it's easy to compete against Apple, which has all the phones out there, and then they can pre-install their Apple Music and they can bundle that into other services? Yeah, it's tough to compete against stuff like that. So we got sales and marketing coming in at 279. That is up. Everything is basically up except for research and development. That's actually down year over year, but it is up quarter over quarter. That gives us, I believe this is total cost. They don't label it here, but they probably should. So you have your gross profit here at 663. We have other cost, R&D, sales and marketing, general administrative. That actually went down a little bit year over year. You like to see that, especially when the gross margins are so small. The reason why I focus on other cost when your gross profit is this small is any increase there and it pretty much screws your net income, okay? Or at least your operating income. So we have 663 in terms of what we grossed in the quarter. We have to minus the 651, and you guessed it, teensy weensy, 12 million euro in terms of operating income. 12 million, okay? Not 120 million, not 12 billion. We're talking about a teensy weensy amount of operating income. Last quarter, we're sitting at 14. Now, in the previous year, they have turned the corner a little bit in terms of controlling their costs and obviously growing their revenue to cover their costs. They were sitting at $167 million euro loss. You see, for the 6 months, you lost 184 million. This period, we're starting to turn the corner with Spotify. Okay, we're turning the corner. We're making money. Okay, we're sitting at 26 million. Obviously, you add this 14 to this 12 and you get to this 26. Now, unfortunately, you got some finance costs, you got some income taxes and those types of things. You get down to a net loss. You still lost money in the quarter. You lost 20 million. You made 23 in the previous quarter and you lost 356 in the previous year. You see, for the year, you made $3 million bucks. Okay. Obviously there's basketball players that are making that in a month. Spotify in 6 months is barely making 3 million euros. Okay. And again, I want you to keep in mind, this is a $43 billion stock. And you're clearing just 3 million for 6 months onto the net income side. And even from the operating side, you're only clearing 26 million euro. It's not great, okay? This is not that great, okay? From a balance sheet perspective, as you'd expect, pretty healthy, okay? Not a lot going on here. So from a balance sheet perspective, not that bad. From a cash flow perspective, doesn't paint much of a different story, okay? They monetize their assets over a longer period of time. Obviously, they buy rights or they receive rights to music, and then they monetize. I don't know if they have to pay that up front all in full, but I know for a fact they monetize that music over a long period of time. And so it's just like Netflix. They produce a show, they have to pay a lot of money up front to do that, and then over time they get the money back through subscription fees and new signups and those types of things. Spotify's not a lot different. From a cash flow perspective, not a lot to see here. I think the main takeaways is if you are bullish Spotify at this price, or even, heaven forbid, even higher, you need this company to grow rapidly, and you need to figure out ways that it will, okay? Obviously, there is demand for streaming music, but it is a very competitive business, and it is one where your costs of revenue will go up over time, okay? Artists have been getting the shaft in terms of streaming deals. At some point, that will reverse probably a little bit, and your costs are likely going to just increase over time in terms of buying this music and delivering it to customers. Now, from a technical perspective, Ooh, this is really ugly. Okay, we topped out here. This is what I'm on is a weekly view. And I think this goes back to when Spotify recently went public back in 2018. And we saw this stock trade down into the 120s. And once it got above 190, okay, it actually got up to 190 shortly after IPO. Came back down, bottoms here at 110, bottoms again at 110, bottoms again at 110, and then came all the way back up here to 190 and then put up a big old green candle. Okay, and then once it broke above 190, technically it was off to the races, and boy, did it ever. This thing got up over $387 per share, but now we are technically in reverse as we are in a very, very steep downtrend. We have a high, a lower high, and it looks like we're probably going to print another lower high down here. Currently, the stock is sitting at $229, and I have that marked out as a relatively critical level right here, right on this solid red line. You see here, it was kind of a launching pad here, but it was an area of support here, acted as support here. Okay, but it looks like to me buyers are drying up a little bit here at 229. If buyers dry up here at 229, all you have supporting this stock is one solid green candle. And yes, there is a lot of volume here, but you got to imagine a lot of people that bought along this candle won't want to take a loss on this one. Okay, and so they are probably not going to want to step in here and buy, okay, because they bought here at between 190 and 229 and saw this thing go up to 390. And so if they didn't sell, they're going to be stuck with this stock for a loss, and that is going to leave a bad taste in their mouth, and they're not going to necessarily want to come in there and buy. They're going to regret not selling up here at 330. If you break this 229 level, you are coming high probability you're coming back to 190 on this one, because that was the area of support and resistance all along this level as it was an early company. And I can expect if we break this 229 number, we are probably going to carve through this green candle at some point. We're wicking through it, testing these buyers, testing the sellers. If it breaks, I'm not saying it will, if it breaks, we are likely coming down here to 190. That would be the first area where I would consider buying Spotify shares, because you could technically get some support here. You'd like for this thing to bounce here at 229. This is the bull case scenario. And really, you needed to get it above 270. So you really need to bolt on like $30 or $40 onto this stock to really break this downtrend that we are on in the shorter term. In the shorter term, I see this one going lower. I don't like this from a fundamental perspective. It doesn't check a lot of boxes. It's not a high margin business. Is it growing? Yes. Is it growing super fast? Is it growing faster than Facebook? Is it growing faster? I just did a video on McDonald's that grew like 50, 60%. It's not even growing really as fast as a company like McDonald's, believe it or not. It's not growing as, I just did a video on Starbucks. Not really growing faster than a company like that pays a dividend, is profitable. They're unprofitable. The valuation is extremely high. From a technical perspective, it looks really, really ugly. I'd wait for it. If you were going to jump in on this one, I'd wait for some kind of bottoming formation. Okay, this downtrend is intact. It might bottom here at 230. In fact, it has a decent probability of bottoming here at 230. But I'd wait, because if it doesn't bottom here at 230, you have a high probability of coming to 190 on this one. So I don't love this one. Pure play business, one-dimensional business. I know that a little bit like audio ads or online ads business is kind of its play. Subscription model, it's kind of its play as well. But it's still one dimension. When you think of an Amazon, when you think of Apple, when you think of Microsoft, Google, to a certain degree Google, but really Microsoft, Apple, Amazon, especially Microsoft and Amazon, how many dimensions is that company playing in? Like, they have massive amounts of business, lots of different business lines, lots of things can go right, lots of things could go wrong. But if things start going wrong with Spotify's business, the stock would just continue to go down. Now, year to date, down 27% over the last year, down 12%. I think we're still headed lower on this one, but we could be in terms of a technical bounce at some point, and that's where I would like to get in on that one. So hopefully you guys enjoyed this video. Back with more. Next company on our list is Shopify. I just did Spotify, and now we're going to do a Shopify, ticker symbol SHOP. This company has a $187 billion market cap over the last year. up 43%. Year to date, up 32% on this one. We'll talk about this one from a technical level as well. It's actually pulling back into a spot where maybe it's worth buying. We'll talk about that here in a second. Now, if you're not familiar with Shopify, I'm assuming most of you are, they really have two different kind of lines of revenue. And so on the revenue side, they have subscription solutions, which I believe is about the $30 a month that they charge for somebody to have a store on Shopify. So basically you sign up with Shopify, they give you like a back end. Think of it almost like a WordPress just for e-commerce. And merchant solution is the gross merchandise value that flows through the stores. So in this case, it was 42 billion versus about 40.1 expected. So the more volume that flows through the Shopify stores, what Shopify does is they skim a little off the top of that, okay? And so inherently, that is always going to be a relatively low margin business because they have to remain competitive with payment processing fees and stuff like that with competitors and other options out there. But that subscription solution business, as we'll see here, is absolutely phenomenal. Now, they are giving very nice guidance. Things are looking good from that perspective. We'll jump into the numbers and then we'll look at this interesting enough from a technical perspective as well. So from the revenue I talked about, we have the subscription solutions. This is the number of shops essentially that are set up on Shopify, and we're seeing consistent growth. We have our 3 months ended here. It went from 196 million up to 334 million. Merchant solutions, this is where Shopify is skimming off the top. So for every dollar in sales, they take whatever, 3% or whatever it happens to be. Went from 517 up to 785 in the quarter. We see here from the cost of revenues, we see the different margins, okay? On the 334, it's just like a software business, okay? Just like a Microsoft or some of the other software businesses that we look at. They only spent $63 million to make this 334. Now, the merchant solution, they have to spend $435 to make this 785. So off this $1.1 billion of revenue for the last 3 months, gross profit's 620. Okay, that's basically, off the top of my head, almost 50% margins. In fact, it actually might exceed that just a little bit. You see, for the 3 months, same thing held true. Okay, off 714 million in terms of revenue, 375 on that growth side. Okay, so you love to see this. Okay, for the 6 month, exact same thing is painting true. $2.1 billion worth of revenue, $1.1 billion flowing down to the gross profit side. So if you are bullish Shopify, okay, think about this. We've got $1.1 billion worth of revenue, operating gross profit over the last 6 months. You want to double that and we'll give them credit for a little bit more, okay? So we'll call it $2.5 billion worth of gross profit. This is not net income. This is gross profit because believe me, this company's got lots of other expenses. So $2.5 billion worth of gross profit and $187 billion market cap. You're paying what? 90 times, virtually 90 times gross profit, not income from operations or net income, gross profit. That is absolutely wildly overvalued, at least at the current time. So if you want this company, and look, every high-flying company like Shopify has to grow into their valuation, from Amazon to Tesla to you name it. They have to grow into that valuation. So what you have to hope for with Shopify is that they've got to keep signing people up to their platform. Number one, that's obvious. And number two, they have to increase the amount of sales through there. So both of those things need to happen. And in order for those things to happen, who are you competing against? You're competing against Amazon, okay? Because as an e-commerce seller myself, is it easier just to sell on Amazon, or is it easier to set up my own Shopify and have to pay for Facebook ads and marketing and SEO and all that stuff in order for people to actually find that website? Those are things you have to think about. And the bigger that this company gets, they're competing against Amazon. They're competing against Walmart.com. They're competing against a Target, traditional retail, all those types of things. They're going to hit their head on that type of thing. I'm not saying that I'm not bullish this company. I'm just saying those are things you want to think about. Now, the other things we need to think about is we got other operating expenses here. We got selling and marketing coming in at 200 million. It was only at 144 in the previous period. Research and development came in at 183. We were at 133 in the previous previous period. General administrative came flat. I love this. Okay, I love when companies, especially younger companies, start to flatten out that G&A. Okay, I don't mind paying for R&D. I don't mind paying for sales and marketing, because typically those two things either lead to sales right now or in the future. General administrative, just back office stuff, not really a cost I really like. Okay, we went from 83 down to 77 million. So you like to see that. Now we got transaction and loan losses. That went from 13.3 last year up to 17.9. Insignificant cost in terms of Shopify. Okay, off $620 million worth of gross profit, minusing 18 million of it. That's not insignificant, but it's not that big of a deal. But what I want to point out to you is over the last quarter, we're seeing lots more transaction and loan losses. Okay, so what it can be telling you is merchants aren't as healthy as they were a year ago. The pandemic, they might be starting to suffer. And the other thing, it could be consumer related as well. Okay, consumers are not as healthy as they were last year. Stimulus checks have run out, those types of things. And we might see more loan losses. So more from a macro environment, I'm looking at that number and seeing it tick up, and I'm thinking, ooh, that's not necessarily a good thing. We'll see what happens in future quarters. We see for the 6 months, it's basically flat. So it could be just an anomaly in the quarter. But if it continues, doesn't necessarily tell us anything specific about Shopify, but it tells us more about the consumer and business out there. Might not be super healthy. Now, income from operations came in at 140 million. Okay, so you had this $1.1 billion worth of revenue. You take away your cost of revenues, you take away about 500 million. That leaves you $620 million worth of gross profit. You take away $481 million worth of expenses, and that leaves you with income from operations. Actually really nice at $139 million. Last year we were sitting at 284,000. Like, this company was basically break even last year. So we've really turned the corner. And I love to see that. Okay, I love to see a company last year sitting at $714 million worth of revenue. In fact, we might have done a video on this, and they were sitting at 284,000, which is basically a rounding error, which basically means this company is break even. But I like to see them follow through a year later. Okay, you followed through. Your costs have gone up in relation to your revenue. Your revenue is continuing accelerated. Now you're clearing $140 million. I like to see that. Okay, 258 on the 6 month. Now they've got some other income sitting on here. 780 million. $2 billion for the last 6 months. My guess is that's investment into other businesses. You can dig into these stock charts and dig into the management explanations to kind of understand that. So from an earnings per share basis, you're at $6.90 per share. Net income sitting at $879, $2.2 billion. That will affect the valuation, right? Okay, so you got net income for the last 6 months at $2.1 billion. I just showed you they had less than that in revenue. So that's why you know this money is, I don't want to say it's a one-time thing, but it's not necessarily something that's recurring. That's why I focus on income from operations. That's why I focus on gross profit, because this gives you an idea how Shopify itself is running, not necessarily like their private equity firm in the back that's making investments, wise investments. Look, and it's benefited you, the shareholder. But it's not necessarily Shopify.com making that kind of money. Now, from an asset perspective, things look beautiful, as you can imagine. They do have these big old convertible notes, so I'd expect more dilution as we move forward. From a cash flow perspective as well, paints just an absolute glorious story, because you have gigantic amount of stock-based compensation at this company as well. And you also have this net unrealized gains on equity and other investments. So Shopify, and my apologies, I don't remember the company that they had invested in. I believe it went public. They made a ton of money, over $2 billion, okay, over the last 6 months. Shopify made on that investment, okay? And we showed you they had $2.1 billion worth of net income. Well, unfortunately, in cash flows, that's not related to operating the business. So you suck that money out. That gives us net cash provided by operating activities at $202 million. And you might say, well, that's pretty good. Off $2 billion, they still cleared $202 million operating the business. And I would agree with that, but keep in mind, $151 million of stock-based compensation. And whether you pay the Shopify employees with cash or stock, it really doesn't make a difference. This is why I don't take into account this cash flow statement dollar for dollar, especially when you have this elevated stock-based compensation. This company is making far less than that from an operating perspective, far less than $202 million, because they'd have to pay the employees one way or another And in all seriousness, you, the shareholder, you actually have to pay for this stock-based compensation. These are your shares being diluted out from under you, okay? As an employee, it's great. Cool, I put in some time, I make some shares, they go up in value, so my hourly basis might actually go up. But you, the shareholder, it actually does affect you. Now, moving over from a technical perspective with Shopify, we are pulling back into a range. I'm on a daily chart here, and you see this stock pulled back in February of last year. So, February of this year, my apologies. February of this year, we topped out here at $14.81 and went all the way down to about $1,000 even. And then we rallied all the way back up. We chopped at $14.80. That's why this $14.80 level is a critical level, because you notice it was a topping pattern here. Buyers just absolutely dried up at $14.80. And then all these sellers stepped in, buyers stepped back in, and then it chopped right where the stock is right now, $14.80, $1,500. Went all the way up, kind of in a euphoria run up to $1,650, and now we're back to $1,500. This is a critical area. If you want to add to your Shopify or start a Shopify position at this level, I'd question it from a traditional valuation perspective, but from a growth perspective, maybe not. But this is not an area where I'd really run out and love this spot. Okay, I think we're probably going to chop here. If we break here, for whatever reason, we break 1,500, just like back we did here, boy, we could come down, and we could come down hard on this one, okay? And we could come down there's not a lot of price action support in this, okay? Where I'm circling my candles right here is between 1,200 and 1,400. There's not a lot of candles in there, okay? There's way more candles down here between 1,000 and 1,200. That's personally where I would really like this stock, is down here in this $1,200 range. So that's what I see with Shopify. Technically, it's on a ledge, and maybe it holds this level. It could be that we hold this level and we resume some kind of uptrend. Not necessarily the game I'd want to play, especially when we're talking about a $187 billion stock on a company that cleared a lot of net income, primarily because of an equity investment in another company. I'd much prefer, and I think it was a firm, actually. I think off the top of my head, now that I remember it, Shopify had invested in a firm, the payment solution platform that allows you to stretch out payments, and is run by a former PayPal co-founder. Believe they invested in them, divested during the public offering, got a bunch of money. From just a financial perspective, we're doing $2 billion worth of revenue. We'll give them credit for even $5 billion worth of revenue. You're still trading at over 30 times sales on this one. And at least on here, from a forward earnings basis, trading way over like 200 times this. Extremely, extremely high valued company. I wouldn't want to pay a high valuation for it. I'd wait for these sell-offs, buy down at these lower levels. That's how I would play Shopify stock. Last company that we're going to cover on the earnings show, mega show, is the Enphase Energy, ticker symbol ENPH. Absolute first here on the channel. Over the last year, stock's been on fire, up 220%. Year to date, a little bit flat, okay? And so we'll talk about that from a technical perspective as well. This one's setting up it's like painting two different stories. And I think it's understandable, right? When you look at this valuation, $25.5 billion market cap on this one. And when we get over to the financials, which we'll talk about now, doesn't necessarily paint a picture of a $25 billion market cap company, at least today, okay? But there are plenty of investors that are investing for the future. The $25 billion certainly makes more sense in the future. And that's why I think you're seeing a little bit of a push-pull when we look at a shorter-term uptrend on this stock chart. Now, longer-term, I mean, this thing's been just on fire. So if you've held this one for a while, you have actually done incredibly well. Shorter-term, we'll talk about it from a technical perspective as well. Now, we come over to our statement of operations, which is revenue, profit, net income, those types of things. We've got our revenues here on the top line. Left-hand column is the most recent quarter. Middle column is last quarter. So I love companies that do this. So we get a quarter over quarter view here. Right-hand column, or the third column, is year over year. So this is last year, this is this year, year over year, and then we get a 6-month window here, year over year. Wish every company did it like this, give us a quarter over quarter and a year over year, but I guess we can bother the SEC about that one. Now, we've got the net revenues here coming in at $316 million. Last year, we were sitting at 125. Hello, that is not quite 3x growth, but it is very close to that. So that's where the box is being checked for some investors. Some investors just love revenue growth, okay? They don't care that this thing's priced at $25 billion and you only got $316 million worth of revenue on a quarterly basis. On a 6-month basis, we're looking at $617 million. You times that by 2, you're at 1.2, call it, give it a little growth, $1.5 billion worth of revenue. Well, yeah, you're paying virtually 25 times sales for a company like this. So from a traditional valuation, oh man, this thing's way overvalued. But from a growth perspective, that's what investors are seeing. Quarter over quarter, we went from 301 up to this 316. Now, not necessarily a high margin business over at Enphase, but not bad at all. Okay, cost of revenue is coming in at 188. So we take this 316 minus 188, you clear 127. Okay, so off 316 million, you clear this 127. Of 6 months, again, we had this $618 million worth of revenue. You paid 367, you cleared 250. Okay, so not bad. These are actually pretty. I wouldn't categorize this as a mega high margin business. It's not like a Facebook or a Google or something like that, but it's not bad. I actually like this. So from a revenue growth perspective, we're checking a box. From a gross margin perspective, I think we're checking a box. Maybe not in like solid green ink, but maybe a little pencil mark. Yeah, we're checking that box too. Let's take a look at these other expenses as well. We got R&D, sales and marketing, general and administrative. Obviously, year over year, we're seeing these things tick up, and we're seeing them tick up big time. Okay, we almost tripled our revenue. Not quite, but it's almost a triple. But we're kind of doubling these, and so that's not bad at all. Quarter over quarter, you did see sales and marketing tick up quite a bit. I don't necessarily mind that much. Everything else, relatively flat, okay? So this company is doing a pretty nice job in terms of controlling costs. Total operating expenses for the quarter came in at $68.4 million. You minus that off our 127, which is our gross profit. That gives us income from operations of $59.4 million. Now that is down quarter over quarter. Some of it has to do with our marketing spend, okay? Because we did grow our revenues from 301 up to 316. Our gross profit was from 122 up to 127, but we increased our sales and marketing budget by like basically $6 million, okay? And that's where some of this income from operations kind of bled out from. Went from 61 million down to about 60 million. And we see though, over the last year, we were sitting at 10 million. So we nearly 6x'd our income from operations. That is fantastic. For the 6 months, we're clearing 120. Give them credit for maybe $250 million. Guys, that's still a forward PE of, at least on, this is not net income. That's like 100 times operating income. So you're paying 100 times operating income. If you were paying 100 times operating income for Microsoft, Apple, Facebook, Google, good Lord, the valuations of those companies would be absolutely fantastic. Okay. And while they're not tripling revenues, they are executing share buybacks. They are growing their revenues rather rapidly. So those are just things you want to think. I'm not telling you to go invest in Facebook over an Enphase. And by no means am I comparing these companies. But from an investor perspective, they are comparable because my dollar is either going to go to a stock like Enphase or go to another stock. And so, yes, I can compare dollar for dollar where that one is going. Okay, so from a lot of it flows down to net income. They don't got a lot of funky stuff happening here. A fair amount of this is flowing down to net income. We did earn 28 cents diluted, 49 cents on that longer period of time, 6 months. Everything else being considered, this company's in very, very nice financial position. Okay, long-term total liabilities are coming in at $1.5 billion. They almost have that in cash, so nothing necessarily to see on the balance sheet. One thing I did see here on the cash flow, repurchase of common stock. So they got a buyback going on, at least from a one-time perspective in the quarter. You like to see that. Now, from a technical perspective, I'm seeing two different things. Shorter term, we are absolutely in an uptrend here. Okay, the stock bottomed out, looks like back in May. Bottomed out down at 110 and has rallied hard up here to 169. But what I want to focus on here is I'll zoom in a little bit into the kind of where our box is in the screen here. I want to show you though, we bottomed out here in May and we came up to 190 on this one. We have not been able to break through. Okay. Hit its head here, got rejected, came down to 160, came back up. Now here we are again at 190. Are the buyers or sellers going to take over here? If the sellers take over, this thing's probably coming back down to 160 at the very least. The other thing that I'm seeing here, that if we get rejected here at 190, we made a high here. Same thing happened up here. We had a monster rally off. Really, the stock likes to rally off of 110. The stock gets to 110. It rallies, and it rallied up to 220. And it failed at 220, came all the way down to 110, and now we come back to 190. What's the problem there if we stall out here at 190? Well, now we have a high and a lower high. And so a little bit longer term trend, you're doing something like this. So you have like a little bit of a downtrend going on there. And so those are the two things that I'm seeing with Enphase. And here's the rub. You get above one, say you want to buy Enphase tomorrow or sometime this week, and you get it right at 190. And let's say the stock continues to rally. Well, where is it going to get resistance? It's going to get resistance anywhere from 210 to 220. That is only about $20 to $30 above where the stock is. Okay. Not necessarily the best risk reward. You'd have to bet on this one blasting up above 210, 220. And again, we talked about this from a traditional valuation metric. This thing doesn't make a lot of sense. Okay, and I don't think it's necessarily going to make sense at any time soon. But if this thing were to come down here and get it back at 110 would be fantastic. In fact, I wouldn't even necessarily wait for it to get all the way back down. Anywhere in this range, 110 to 120, you could probably even bump this up to 130, okay? Anywhere down in here, the stock likes to bounce. Buyers step in down here at 130. You like to get it down there. Again, that's $50 lower than where the stock is trading right now. And so you've got, I'd say about $30 in upside in this one until you hit some resistance. But you got about $50 in downside before you hit some areas of critical support. So I'd wait on this one, me personally. Because here's the other thing, okay? Let's say it rallies and you're like, gosh darn it, it rallied from where it's at, 189 up to this 220 level. And you're like, gosh darn it, I shouldn't have listened to that investor channel guy. He has no idea what he's talking about. Well, here's the deal. You get above 220 and you put a candle up above here. Well, it is green skies, and we've seen this with Google. We've seen it with Facebook. We've seen it with a lot of stocks, and we're talking about mega cap stocks. These smaller to mid cap stocks, I wouldn't necessarily call 25 billion a mid cap stock, but these quote unquote smaller stocks compared to mega cap tech, these things could run. Okay, you get above this 220 level, and gosh, we could come to 230, 240, 250. So you could have your $20 to $30 upside up here, and I think be a lot safer because you could put a stop loss right. You could buy it at 220, put your stop loss at 215. Okay, because if it breaks back down, this was probably just a little bit of a fake out, and it's coming back down. So that's probably how I would play this one. I would either play the rip above 220 if we were able to get that, or I'd play the rejection either here at 190. I'd play the rejection down here, or I'd pay the rejection if it got to 220 and got rejected. I think you could buy it. Maybe it comes back to this level. You could buy it with a little bit margin for safety. So we're looking for those types of things. If you're just a gambler, you just throw money at the stock market, I don't think that's a sustainable way to invest. You're looking to enhance your odds. It's just like if you're walking through a casino, and a casino is probably a bad analogy, but you're looking to enhance your odds. Maybe it's like playing golf, okay? If you've got a shot, you're trying to enhance your odds for the next shot. So you're not necessarily trying to play over a bunker or some water or play to a tight pin. You're maybe trying to leave yourself a 15-foot putt instead of trying to go for the 2-foot putt, and where you might end up in the bunker or the water if you mishit it a little bit. Same thing with Enphase Energy. We don't want to mishit this, okay? You mishit this, and this thing could come down 40 or 50 bucks, and you're wiped out, okay? Quite a bit on that position. So we're trying to enhance our odds. I'd play the rip above 220 or the rejection at 220 or the rejection at 190. Anywhere down here at 110, 120, I might be joining you buying this, not from a longer term perspective, but from a swing trade perspective. This thing would bounce down here and would bounce hard. And I think you probably got $30, $40 in upside on that when you set a trailing stop. Probably when you get here to 150, 160, you let it run and you make a couple bucks. That was the mega stock show. If you have any stocks that you'd still like me to cover, I'll try to come back again next week and do another one of these. We'll have lots of individual videos over the coming days and and weeks ahead. Thank you everybody for watching. Hit that like button and that subscribe button if you haven't already. And I've got some referral links in as well. I've spent the morning out here recording videos away from my kids to make you a better investor. If you would do a few things for me, I would appreciate it. Thanks for tuning in today. We'll be back again soon. Good luck with your investments.